Silver has moved through the global system as a secondary metal, closely watched but rarely centered. And now it's quietly crossed into price territory not seen in roughly 40 years. A shift that institutions tend to notice long before headlines catch up, which raises a question markets haven't fully answered yet. At first glance, the move looks deceptively simple because prices rising to long-dated highs often get framed as momentum or speculation, yet this particular level matters less for what it says about silver and more for what it signals about the environment allowing it to happen, an environment that feels increasingly unstable beneath the surface. Historically, silver only reaches these extremes when multiple pressures overlap, not when a single narrative dominates, and current market behavior suggests that several unrelated systems are leaning in the same direction at once, a convergence that rarely resolves cleanly. Behind the numbers, the timing itself is uncomfortable because this high arrives while policy expectations, currency confidence, and industrial demand are all being quietly reassessed, implying the price may be reacting to stresses that aren't fully visible yet. What makes this moment harder to dismiss is how restrained the reaction has been from traditional volatility indicators, as if the market is treating this level not as a climax, but as a checkpoint, leaving open the possibility that something unresolved is still forming. And when an asset long treated as peripheral begins behaving like a signal rather than a trade, the question stops being how high it went and becomes why it was allowed to go there at all, a question that doesn't have a comfortable answer yet. For much of the past 4 decades, silver's price ceiling acted like an invisible boundary, tested occasionally but never breached for long, and the fact that it's now sitting beyond that range forces a reevaluation of assumptions that have quietly guided institutional positioning for years. What's striking is how little fanfare accompanied the move, because markets usually telegraph major breaks through noise and volatility. Yet this shift unfolded with a controlled, almost procedural feel, suggesting that larger participants may have already adjusted internally before the level was crossed. Available data suggests that this isn't being driven by a single surge of demand, but by a gradual tightening across several channels at once, where supply flexibility, inventory turnover, and hedging behavior are all becoming less forgiving at the same time. In previous cycles, similar price zones triggered aggressive selling from producers and paper markets, but recent behavior implies that those traditional release valves are either constrained or being used more cautiously, a subtle change with significant implications. That hesitation matters because it hints that confidence in future availability may be weakening, not collapsing, but softening just enough to alter risk calculations, which tends to happen only when long-term visibility starts to blur. And once that visibility fades, prices stop reflecting current conditions and begin discounting what participants fear might be coming next, a shift that often precedes deeper structural moves rather than marking their end. At the institutional level, long-term price anchors matter less for trading decisions than for risk modeling. And when silver moves beyond a 40-year reference point, it quietly disrupts models built on the assumption that certain extremes remain theoretical. Those models don't break immediately, but they do require recalibration, and that process tends to expose where hidden leverage, timing mismatches, or supply assumptions were never stress-tested for this kind of environment. What's notable is that this recalibration appears to be happening without disorder, which implies preparation rather than reaction, as if some participants anticipated that legacy price boundaries were no longer reliable guides. Market behavior implies that silver is being reclassified, not formally or publicly, but functionally, from a cyclical commodity into something closer to a strategic input with price sensitivity, extending beyond simple industrial cycles. That distinction matters because once an asset is treated as strategically sensitive, liquidity provision becomes more selective, and price discovery slows even as prices rise, an unusual combination that can persist longer than expected. In this phase, movements stop being about attracting new buyers and start reflecting how willing existing holders are to part with supply, a dynamic that can tighten suddenly if confidence shifts. And if that willingness continues to erode while demand remains steady, the 40-year high may end up looking less like a peak and more like a threshold that redefines the market's operating range. Behind closed doors, conversations around silver have been changing tone, not because of a single shock, but because long-standing assumptions about flexibility and substitution are being quietly questioned at the same time. For years, silver's role in industrial systems came with an unspoken belief that higher prices would naturally curb demand or unlock new supply. Yet recent market behavior suggests those responses are becoming slower, more fragmented, and less reliable. Reports indicate that certain end users are prioritizing continuity over price sensitivity, a subtle but important shift, because it alters how price signals function across the supply chain. When buyers focus on securing material rather than optimizing cost, prices stop acting as a balancing mechanism and start reflecting stress, even if volumes don't change dramatically. This kind of environment often looks stable right up until it isn't, because pressure builds invisibly in procurement decisions, contract structures, and inventory policies, rather than in spot price volatility. That pressure doesn't announce itself, but it accumulates, and once it reaches a threshold, price moves tend to accelerate without the usual warning signs, which raises the uncomfortable possibility that the current high isn't the result of excess enthusiasm, but the early expression of a system adjusting to constraints it can no longer ignore. For decades, monetary policy shifts tended to dominate narratives around precious metals, but this move in silver doesn't align cleanly with any single policy signal, which is why it's attracting quiet attention rather than loud conviction. Market behavior suggests that silver is responding less to short-term expectations and more to longer horizon uncertainty, the kind that builds when confidence in forecasting itself starts to weaken. That distinction matters, because assets driven by uncertainty rather than outlook don't retreat easily once conditions stabilize. They linger, reflecting unresolved questions rather than answered ones. In this case, the questions appear tied to how resilient financial and industrial systems really are under prolonged strain, and whether buffers assumed to exist are thinner than models suggest. Silver's price action implies that some participants are no longer comfortable relying on those buffers, choosing instead to pay for optionality even at levels once considered extreme. When optionality becomes valuable, markets stop pricing outcomes and start pricing flexibility, a shift that often goes unnoticed until it reshapes entire segments. And if that repricing is underway, the 40-year high may be less about where silver is today and more about what participants are preparing for tomorrow. Historically, when silver approaches long-dated highs, the focus narrows to the metal itself, but this time the more revealing signals are emerging in adjacent markets that tend to react only when underlying stress becomes persistent. Correlations that usually remain stable are showing signs of strain, not through sharp breaks, but through gradual divergence, suggesting that traditional hedging relationships are being reconsidered. That kind of adjustment often reflects a shift in how risk is being distributed rather than eliminated, with silver absorbing pressures that might otherwise surface elsewhere. What's notable is how measured that redistribution appears, as if institutions are testing boundaries rather than committing fully, probing how far the market can move without triggering disorder. This behavior implies caution, but not skepticism, because participants rarely test a market they believe is about to reverse sharply. Instead, they test markets they think may be entering a new regime, where old reference points lose relevance and new ones haven't formed yet. If that's the case, the current price level may be functioning as an early stress marker, one that will only make sense in hindsight once the broader adjustment becomes clearer. At this stage, what matters most isn't the headline number, but the absence of resistance where resistance was expected, a detail that tends to unsettle risk managers more than any single price spike. When long-standing barriers fail without confrontation, it suggests that opposing forces have stepped back, not been overwhelmed, leaving the market to discover a new balance point on its own. That vacuum can persist longer than many anticipate, because re-engagement requires confidence, and confidence is slow to return once assumptions are questioned. Silver's behavior here implies that some participants are deliberately staying underexposed rather than aggressively short, an approach consistent with uncertainty rather than conviction. In previous cycles, this kind of hesitation often preceded wider repricing across related assets, not immediately, but methodically, as models were updated and exposures reweighted. Those processes rarely make headlines, yet they shape outcomes far more than visible trades, and they tend to unfold on timescales that outlast initial excitement, which means the significance of this 40-year high may only become clear as these quieter adjustments continue to ripple outward. For decades, silver's extremes were treated as historical artifacts, reminders of past dislocations rather than reference points for present risk, and that mindset is now being tested in real time. What makes this moment difficult to categorize is that nothing appears broken, Yet several systems look less comfortable than they did before the level was crossed, a subtle imbalance that tends to matter later rather than sooner. Market behavior suggests that participants are adjusting posture without fully committing to a narrative, holding space for outcomes that don't fit cleanly into prior cycles. That kind of positioning reflects uncertainty about duration, not direction, because the market seems less concerned with whether prices pull back and more focused on whether the old range still applies at all. If the range has shifted, then the significance of this high isn't tied to reversal risk, but to normalization risk, the process by which elevated levels quietly become accepted. And once acceptance sets in, attention moves away from price and toward consequences, such as procurement strategy, balance sheet exposure, and policy sensitivity. If those consequences begin to surface, the 40-year high may come to be seen not as an event, but as the moment the market stopped pretending the old framework still worked. For decades, silver's long-term highs functioned as warnings, markers of stress that markets expected to fade once conditions normalized, and what makes this moment different is the growing sense that normalization itself is being redefined. The market isn't behaving as if it needs to unwind this level quickly, nor as if it needs to defend it aggressively, which suggests a quiet acceptance that something structural may have shifted beneath the surface. That acceptance doesn't imply certainty or confidence, but it does imply adaptation, as participants begin adjusting assumptions rather than waiting for a reversal to restore the old order. When that happens, price stops being the story and becomes the evidence, a reflection of deeper changes in how risk, availability, and resilience are being assessed. The significance of this 40-year high, then, may not be measured by what happens next week or next month, but by how rarely the market refers back to the old benchmarks going forward. Because once a level that defined an era loses its authority, it's not the metal that's changed most, but the system around it. And that's the kind of shift markets only recognize after it's already become permanent.